All right, here we are at another episode of Flipping Houses for Rookies. Good morning, Peter.
Oh, God help us. Good morning, Bill.
Here we are, episode number 302. We're chugging along with those episodes. So the name of today's episode is How to Retire Comfortably with Real Estate Using Private Money, starring the national speaker, Jay Connor. So here's a little description of what he's going to do, or what we're going to do together. So here we go. Are you tired of feeling frustrated from losing real estate deals because you don't have the funds to get them, or not being able to act quick on those hot deals? Do you think the only place to get money for your deals is from the bank?
Ooh.
Even worse, have a colorful past with your credit and won't qualify? If you would like to fire the banker and learn a proven and tested private money formula, this podcast is going to open your eyes on how to get the keys to the vault on getting more real estate funds than deals. Today's guest speaker, Jay Connor, plans to tell us how he fired his banker and raised $2,150,000 in less than 90 days in 2003 in a town with a population of like 40,000 people, and has done over 300 deals since then with the average profit of $67,000, and has been involved in over $52 million in real estate transactions. This leading expert on private money is about to put your real estate career on steroids. So listen carefully and take some good notes. Mr. Jay Connor, welcome to our podcast. As we just spoke a few minutes ago, we don't have many speakers, but here you are.
Well, Bill and Pete, I'm honored to be here on the show with you. Thank you so much for inviting me to come along and talk about my absolute favorite subject in this world of real estate investing, and that is private money. Private money has had more of an impact on my real estate investing business than any other strategy, any other knowledge, any other business practice. It's catapulted my business when I first started using it, when I first started using private money. Since that time, I've never missed out on a deal for not having the money. I love this world because we make the rules. The banks don't make the rules. It puts us in the driver's seat. And as you just alluded to in the introduction, we've got a really, really good problem these days. And that is we got more money available than we can find houses for.
Yay!
So I'm excited to be here to pull the curtain back and talk about exactly how I do it and how exactly anybody can do it once they learn just a few key strategies.
Okay, so let's start off with this story. I'm dying to hear this story about how you fired your banker and in 90 days you raised over $2 million. How'd you do that?
Well, I tell you what, how did I get into private money? Well, I'll tell you how I did not get into private money. I did not just wake up one day and say, hey, I think I'll go raise some private money for my real estate deals. No, this is a situation that was born out of the necessity to overcome a big obstacle and a challenge. And Bill and Pete, I'm sure you can relate. And for the person listening to this podcast and show, I'm sure you can relate to it as well. You know, how many times in life have you been through a very challenging situation? You really had no idea how you were going to get through it. Everything looked dismal. Everything looked like the sky was falling. Didn't know how you were going to get out of the corner. And when you pushed through and you came out of the other side, wow, life was actually better than it had ever been before. Because let's face it, all growth in business, all growth personally takes place in the valleys and does not take place on top of the mountain. So I remember it just like it was yesterday, Bill and Pete. I was sitting here at my desk. Now, from 2003 to 2009, Carol Joy and I started in this business of investing in single family houses. We've done commercial deals as well, but we started investing in single family houses in 2003 full time. And
So
from 2003 to
Jay,
2000.
sorry to interrupt. Carol Joy, just for in case somebody doesn't know, Carol Joy is your wife, correct?
Correct.
Yeah,
Carol,
sorry. Just
correct.
in case somebody doesn't know that. Sorry to interrupt you.
All good. So we started investing full time in 2003. And for the first 6 years, from 2003 until 2009, we relied on local banks, mortgage companies, traditional lenders, institutional money to fund our deals. And I remember it just like it was yesterday. In January 2009, I picked up this very telephone receiver. And yes, believe it or not, we actually still have landlines in North Carolina. So I picked up
What's that?
now, once in a while, I do use a cell phone. But, I picked up this phone right here, and I called Steve, my banker, my local banker down here the street. And Steve and I had this conversation many, many times. I'd given him more business to fund my deals than anybody else. And I got Steve on the phone and I said, Steve, we did a little chit chat. And I said, Steve, I got 2 deals under contract representing over $100,000 in profit. One of those deals is over here in Newport. After repaired value is $200,000, $150,000 is required to fund. And, I want to close in 30 days because back then, using traditional money, you couldn't close quickly like you can in private money. So I'm on the phone with Steve, and Steve did something that's never a good sign. He closed his throat up, shut his mouth, didn't say a word. And I'm going, hey, Steve, are you still there?
Hello?
Like, hello? What's going on?
Is this mic working?
Steve finally cleared his throat and he says, Jay, of course, and I'm listening. Jay, I'm sorry, but the bank has closed your line of credit. You no longer have funding for your deals. And I'm sorry. I said, what do you mean you've closed my line of credit? I've had perfect credit. I've got an 800 credit score. I've got never late on a payment. We got a 6-year history of relationship, doing many deals. What happened? What's wrong? He says, well, we're just not loaning money out to real estate investors these days. And so I hung up the phone and I quickly learned that I was not the only person in the world that had that conversation. You may remember what was going on in 2008.
Oh, yeah.
In 2009.
Oh, yeah.
It was a global financial crisis. It's like the spigot turned off overnight. And so when I hung up the phone, I had a choice. I could either choose to quit or I could find a better way to fund my deals. Well, I created and started saying a new mantra right there that day. And my mantra became, it is impossible for you to fail unless you choose to quit. And quitting was not a choice for me. It's impossible for you to fail unless you choose to quit. So quitting wasn't a choice. So I picked up the very same phone very quickly and I called my lifeline, right? I called my friend, Jeff, who lived in Greensboro, North Carolina at the time. He was a full-time real estate investor at the time. And I said, Jeff, and I told him what had just happened. He said, welcome to the club. I said, what club? I said, what club? He said, the club of losing your line of credit at the bank for your real estate deals. I said, oh, you lost yours. He said, yep, they cut me off last week too. I said, well, what are we going to do? He said, well, there's this gentleman down in Jacksonville, Florida by the name of Ron LeGrand that can tell us about private money. I said, what's private money? He said, I don't know, but Ron said we can get a lot of it. I said, okay, let's go. So that was actually my very first real estate investing seminar I went to. And I went there for the purpose of learning about private money. I'd already been in the business for 6 years. So I learned about private money. I came back home and I put my private lending program together. What I mean by that is, what was I going to offer and teach? There's a key word, because I've never asked anybody for private money. Never. I've never asked anybody for money to fund my deals.
Wait a minute. How do you, if you never asked them, how do you get the money?
Exactly. And I hear that question all the time because I don't chase, I don't beg, I don't sell. They say, how do you do that? It's real simple. And this is a writer downer. I put on my teacher hat. I become a teacher and I teach people what private money and private lending is. I teach them about self-directed IRAs. There's a big one. Carol Joy and I have got right now about 44 private lenders funding our deals, and over half of them are using their retirement funds to fund our real estate deals. So if you don't know about self-directed IRAs and establish a relationship, there's an actionable item. Establish a relationship with a self-directed IRA company so that when you're talking with someone that has retirement funds, you got a company to refer them to so they can transfer funds over and that can now start lending you money. But nonetheless, how do I get all that money? Right now, I got a little over $8 million in private money available that we just moved from projects to projects to projects to projects. And so I teach them, right? So one of the first things to do is to put your private lending program together that you're going to teach people about. You know, it's a 180-degree shift, a 180-degree shift in direction. When I was borrowing money from the banks, who made the rules? Of course, the banks made the rules. The banks determine the interest rate. The banks determine how often you make your payments. The banks determine what your down payment is, which, by the way, in this world of private money, there's never any down payment. In fact, I always bring home a big check when I buy. I mean, look right here. 2 days ago, I brought home a $29,000 check right there for buying a house.
Wait a minute. Wait a minute. You're making money borrowing money?
Yeah, because I always borrow more than I need to buy. But anyway, so much to talk about private money. Don't let me digress. Just sticking with answering the question.
Jay, that's
how did I raise over
Jay,
$2
that's a
million?
good digress. He makes money borrowing money. I'm sorry. I'm stuck on that.
Jay, before you go any further, you got to drop the bomb. Like you're telling us to go with these equity companies. Can you tell us a couple, one or two, just drop a bomb there and tell us who we should call? Who should we
You're talking about the self-directed IRA company?
Yeah, you said we should go get familiar
and I
with
have
them, right?
worked. I'm sorry?
We should go get familiar with them. Like, who are they?
Absolutely. So I have worked with more than one self-directed IRA company. And hands down, I mean, the past few years, I have redirected and I've referred all of my private lenders to move all their funds to this one company. And that company is Quest Trust, Quest, Quest Trust, out of Houston, Texas. They also have multiple offices. They got them in Dallas and Austin, but they serve the nation. And what's beautiful about Quest, they fund deals in 3 days.
Nice.
3 days. Nice. From the time that, now Quest does not loan money. Let's get that straight. Quest is a third-party custodian that is the third-party manager of people's retirement accounts. And then those people that have retirement accounts at Quest then self-direct. That's why it's called a self-directed IRA company. They self-direct and choose where they want to invest their money. So people with retirement funds can loan money to us real estate investors, at least tax deferred, if not tax free, depending on the kind of retirement account they've got. I've got one private lender that in 1 year earned $65,000 from me and my company, tax free. Right. So that's definitely one strategy, one piece of information people want to learn about. Bottom line answer to your question. How did I get $2,150,000 in?
Please, we're on the edge of the seat waiting.
Yeah. So step number one, I learned about private money and I put my private lending program together that I was going to teach people that I already have some kind of relationship with. Now, there's 3 categories where you get private money. There's your warm market. Those are the people I taught. Your warm market is people you have some kind of relationship. You know them somehow. They're in your cell phone. They're in your email list. They're Facebook friends. You go to church with them. You go to the Rotary Club. Any kind of connection, your LinkedIn connections, any kind of connection you got with these people. And that's your warm market. right? And the second category of private lenders are what I call your expanded warm market. How do you expand your connections? I tell people the more money you wallow in, the more money sticks to you. So go make more connections. I teach that big time to my students. And then thirdly, the third category is called existing private lenders. Where do you find existing private lenders? Well, they're all in public record, because when a private lender is loaning money to a real estate investor, if their loan is secured, which it should be by a mortgage or deed of trust, that's on public record. But yeah, that $2 million when I started, I put my program together. What's my interest rate? What's my term? How am I going to protect them in case I lose my mind and move to the Caribbean? How are they protected? And I simply just taught them. And now here's the deal. After teaching the private lending program, which, by the way, let's go ahead and tease. Let's go ahead and tease somebody here. On this show, I'm actually going to give you for free my brand new money guide that will walk you through step by step my program and how that works. Teaching the program, and by the time it's a 20-minute conversation. And after we teach the program, then guess what? I shut up. They're chasing me. They're saying, "Hey, Jay, what do I do? Write you a check?" No, nobody writes me a check. We get a deal, they fund a deal, and all of their funds are sent directly to the real estate attorney's trust account. But yeah, become a teacher.
So when you say become a teacher, you're talking about teaching not students. You're talking about teaching the people that are going to lend you the money, right?
Correct. I'm teaching potential private lenders that I already have some kind of relationship with.
Nice. And Jay, just so you're aware, Pete and I have talked a lot, because we've got a lot of podcasts about, you don't go looking for money. You know, in other words, I think the saying that we use is money doesn't find deals, deals find money, right? So when you're talking to customers or you're talking to potential lenders, what we do is we always talk to the potential lender about a deal we might have. And that as well, you know, they ask, you know, how they can get involved, and that's when we get into the education process. So that's
I do it a little bit differently, and the way you're doing it is fantastic. You know, all of us do it a little bit different. I do it a little bit different. What I do is I teach my program, but I don't talk anything about a deal up front.
Yep.
Because I don't want to come across, and I'm not saying you and Pete do, but I don't want to come across up front as I'm like desperate for them to fund this deal.
Right.
I just want them to buy into this program. I want to teach them the program. And then they say, yeah, I love the program. They tell me how much they, you know, have to invest. Is it liquid capital? Is it retirement funds? Do I need to introduce them to my representative at Quest so they can move their funds over, that kind of thing? And so we get all set to go. And then they're like biting at the bit. Yep. They're like biting at the bit for me to call them with good news. I can now put their money to work. And here's the deal. I've never pitched a deal in my life. Yep. I've never pitched a deal. And here's why. They bought into the program. They love the program. They're sitting back. Now I go back and I got a deal. It might be in 2 days. It might be in 2 weeks. And Pete and Bill, here's exactly what I do. I call them up and I have a little chit chat. And here's exactly what I say. I say, I've got fantastic news for you. I can now put your money to work for you. They've been waiting for this call. They've been waiting for the call. And like the most stupid thing I could ask them, Bill, is, do you want to fund this deal? Well, of course they want to fund the deal. Of course they want to fund the deal. They've been waiting for the phone call. And I'm not going to bring them a deal that does not fit the criteria of the program that I already taught them. So when I call them up, I only tell them 4 things. 4 things. I call them up and I say, I got great news, Bill. You're my private lender. Let's pretend. Bill, I got great news. I can now put your money to work. And I tell them 4 things. Where the home's located, after repaired value, funding required, and when to wire the funds. Here's how the conversation goes. Bill, I got fantastic news for you. I can now put your money to work for you. I got a home over here in Newport. The after repaired value is $200,000. The funding required is $150,000. You see, I know you've already got $150,000 because you already told me,
yep,
right? When you bought into the program. And it requires $150,000. You'll need to wire your funds to the real estate attorney by next Thursday. End of conversation.
Nice.
I didn't ask them if they want to fund a deal. That's stupid. I mean, if I ask them if they want to fund the deal, they're thinking, maybe I shouldn't fund the deal. I don't know.
Yeah.
Maybe should I? Shouldn't I? Of course they want to. So it's all about positioning, timing, first things first. Money comes first. And I tell you, I'm just not interested in being stressed out on getting a deal under on getting a deal under contract, and I have no idea how I'm going to fund it. And now I'm like running around with my hair on fire, looking for funding. I know right now I've got X number of dollars lined up from a private lender or private lenders. I mean, how much more confident do I feel on making offers when I got $500,000 or $1 million burning a hole in my pocket?
Amen.
To invest in deals. So that's just sort of my approach.
So Jay, you're saying that people are not as concerned of the deal itself. They have enough trust in you that just the numbers of what they're going to get is what they care about. How they get it, what you got to do. Who cares? It's like when you give the money to the bank. You don't say, how are you going to invest it so I get my piece? I want my 0.0001% definitely in 6 months from now. And I totally trust the bank to give me that, right?
Exactly. Yeah.
Okay.
As a matter of a couple of weeks ago, the average 12-month certificate of deposit yield in the local bank is 0.17%. That's nationwide. That's less than 0.25%. And, people just don't know what to do, with their money. And, Pete, you make a good point there a second ago. The first time I call up my lender that's already told me how much they got to work with, get me a deal, get me a deal, get me a deal. So the first time I call them up and tell them those 4 things, great news, where's it located? They could care less what the street address is, the community, where's it located? What's the after repaired value? I don't even tell them the purchase price. They could care less, right? They just want to know, how are they protected? What's the value of this home after it's going to be all ready to sell, and the closing date and how much to fund. Now, on the second or third call, I don't even tell them that much because they can care less.
That's true.
You all know that. You all know this, Bill and Pete. By the second or third call, all they want to know is what? How much and when?
Yep.
Yeah.
How much and when?
No, I want to be very clear here. So I myself have been doing this for 21 plus years. I don't know if you know that. I know my listeners do, and I've done hundreds of transactions. Those 21 plus years and those hundreds of transactions, I can honestly say I've had less than a handful of private lenders. And because of the economy and the way things are changing, and because of meeting you, Peter and I have bought your materials, and we are like absorbing it because I want to make changes, because I feel like the way I'm doing is a little old fashioned. I'm very comfortable with what I'm doing, and my lenders are, like you said, I call them up and they're like, how much? It's like not even hello, how much, Bill? And they're like, and I don't even tell them where to bring it. They know where to bring it. They just tell them how much, and I need it by Thursday, and make sure you go see Maslik, the attorney. And they're like, okay. And it's that easy, right? So
absolutely.
So I just want you to know that, that obviously, I don't feel it. And I think you're the same way. I don't have this arrogance. Like I know everything. I'm still learning. I'm still buying materials. I'm absorbing your stuff. I love the way you do things. I love your personality and your how you talk to people. It's just amazing. So maybe you can give us a short. I know one of the things that I run into a lot of times with my students is some sort of a short, or it doesn't even have to be short, some sort of a description between the difference between private money and hard money. Like, because those are 2 words we use in the real estate business a lot. And I just want to make sure that our listeners know the difference, because it's important. I think it's important.
Bill, I'm so glad you asked. It's like critically important because particularly newer real estate investors may hear those terms and use hard money and private money interchangeably, and they are night and day. So first of all, very simply, let's define what's a private lender and what is a hard money lender. And then let me take a moment and break down the differences and give you a contrast.
Perfect.
First of all, a private lender, and if you are riding down the road in your car listening to this, obviously don't take notes. But if you are where you can take notes, now is the time to take notes. If you're listening in your car, I recommend you go back to this episode and listen to it again. A private lender, by definition, is a human being, an individual that loans money to a real estate investor, primarily and most of the time, either from their investment capital, liquid funds, or their retirement funds. As we were just talking about, people being able to move existing retirement funds over to an IRS-approved third-party custodian called a self-directed IRA company, i.e. Quest Trust out of Houston, Texas. So a private lender simply is an individual, a human being, just like you, just like me. We call it mom and pop money. Mom and pop money. It's not institutional money, right? We call it relationship money, all right? All the same thing. That's a private lender. Now, in contrast, what is a hard money lender? Well, most of the time, a hard money lender is a broker of money. It's most of the time, it's a company. A hard money lender most of the time is not an individual. However, sometimes they are. Regardless as to whether it's an institution or an individual, a hard money lender is a middle person. A hard money lender is going out and raising private money from the individuals like we do, and then they are loaning that money out as a middle person to real estate investors. So how do they make money? They make money on money. Well, here's how they do it. If they borrow at, say, 8%, well, then they're going to loan that money out at, say, 10, 12, or 14%. So they're borrowing at a lower rate than they're lending out at. So they're upping the interest rate. How else do they make money? They charge points or origination fees. To be clear, what's a point? What's origination fee? Well, for easy calculation, let's say you're borrowing $100,000. If the hard money lender is charging you 4 points or an origination fee of 4 points, then that's 4% of the amount you are borrowing. In this example, $4,000. That would be an origination fee that you would bring to the closing table out of your own pocket. A private lender charges 0 points, no origination fee, right? So what else is different? As I said, the interest rate. Hard money lender is going to borrow at a lower rate, charge you a higher rate. We, as the real estate investor, when we borrow from the private lender, we're going to borrow that straight interest rate. So right now, I'm paying most of my private lenders 8%. 8%. I've got some colleagues now, due to CDs being so low, only paying 6%. But I'm paying 8%, 0 points. Here's another big difference. So far, you got a big difference in interest rate. Average rate right now is 14% in hard money, 8% for private money. And by the way, just as a caveat, when COVID first came along in 2020, you couldn't even borrow hard money. It was gone. They all shut down. Guess what? In this world of private money, I had more money starting to chase me during COVID than prior to COVID. Okay. So interest rates different. No origination fees as opposed to hard money. Then you have extension fees. Wow. So most lengths of notes, most terms on hard money is 9 months, 9 months, 6 months, 9 months, 12 months, that kind of thing. And if you haven't cashed out, then they'll probably extend your note for 90 days. But what do they want? More money. They charge you extension fees. In this world of private money, they never charge extension fees. They just want you to keep the money at work because they don't want the money back. So extension fees. I know one hard money lender that charges 2 points or 2% for every extra 90 days you borrow it. So if you paid 14% and 4 points when you borrowed it, that's 18%. And then if you extend the note, that's another 2%. And that's just for 90 more days. You're up to 20% just on that deal. In the world of hard money, you're still at 8%. Now, here's another big difference. Big difference. You make the rules. We said that starting out. So what I mean by that is you as the private lender, when you're borrowing private money from your warm market, expanding warm market, existing private lenders, you make the rules. You set the interest rate. You set the frequency of payments. You can even structure deals to where you make no payments whatsoever until you cash out on the deal. You think that'll help you cash flow? Absolutely. So think about this on cash flow. Make no payments at all until you cash out, and bring home a big check when you buy, and take none of your own money to the closing table. That right there helps.
No way. That's not possible. No way. For real?
Do it all the time. Do it all the time. Now, one more biggie. The amount, well, I just sort of said it in a different way. So now I'm going to drill down. Hard money lenders, how much money are they going to advance to you when you buy a property? Okay. How much money are they going to? So Bill, Pete, y'all ever borrowed hard money in all your years? Y'all ever borrowed hard money?
I started with hard money, and it
So when
was
you
and it was 65 to 70% they would max me at.
So listen at what Bill just said. Borrowing hard money, they would only give Bill 65 or 75 or 70% of the purchase price.
That's right.
Regardless of how good the deal is,
Yeah.
regardless of what the after repaired value is. So let's say, Bill is, buying a house with an after repaired value of, he's buying a purchase price, let's say of $100,000 for easy figuring. He's buying it at 100. It's got an after repaired value of 200. He's buying it for 100. The hard money lender is only going to give him, when he purchases, 70,000 or 75,000. The national average right now is 80%. So even if you can get 80% of purchase, you're only going to get $80,000 of that $100,000 purchase.
But where am I going to get the money to renovate it? How am I going to renovate it? Because that's what I had to do. When we first started, he gave me 70% of the ARV, this is 20 years ago. And then we had to put up the renovation money for the first 3 or 4 deals to get a relationship with him.
Absolutely. So it's like we have to come up with the balance, but not in the world of private money. In the world of private money, we get 100% of our purchase price, 100% of all the rehab money, and extra money to even cover carrying costs, utilities, taxes. And some of my private lenders, Pete, they need monthly payments because they're elderly and they're looking to live off of this money. Well, follow this cash flow. You buy a house, you bring home a big check because you always borrow more than you need to buy it. You bring home a big check. Well, whose money are you using to make their initial monthly payments if they need monthly payments?
Theirs.
You're using their money.
Oh.
So I'm borrowing their money to buy, borrowing their money to rehab, and I'm using their money initially to make the initial monthly payments. But beware, that money's going to run out. So we got to get that house cash flowing. We got to get it rehabbed. We got to get it on the market, et cetera. And I want to make this quick point, Pete and Bill, while it comes to mind. Private money is not only for the ugly house business.
Thank you. This was the big aha moment I had when we were at the seminar where you were speaking. It was like, oh my God, we don't need to borrow private money, because I was always ingrained that when you buy with money, you sell for money. When you buy on terms, you sell for terms. And you don't do that. So do tell.
Yeah. So obviously we're going to use private money all cash. Well, here's the bottom line. Use private money to buy the property when the seller requires all the cash. Period.
Yep.
Now, the seller could be a bank-owned property. Obviously you're going to use private money. The seller could be having a property in distress, needs rehab, needs major work. It's an inherited property. Heirs could care less, needs work. Now, a pretty house, or as we say in North Carolina, a purty house. Right?
Pretty.
So you got a pretty house. Now, my definition of a pretty house is it needs like less than 10,000. Maybe it needs 5,000 in repairs. Maybe it doesn't need any repairs, right? And let's say the pretty house seller will not sell to us on terms. All right. So let's cut the lingo and the jingo and break it down.
Now that's
Let's
not
say that-
that's not
let's
the
say-
market right now, Jay. Come on, they all want to sell on terms today. Come on.
My experience and all my statistics of reviewing thousands of property lead sheets, only 17% of FSBOs for sale by owners, it's not in the multiple listing service, it's straight from the owner. Only 17% of those sellers will sell to me creatively. What do I mean by that? Only 17% of them will sell to me subject to the existing note. If you don't know what that means, Bill and Pete will do a show on it. They won't sell to us on subject to the existing note. They won't sell to me with seller financing. They won't sell to me on lease option. They want all the cash. Well, guess what? That's 87% of FSBOs want all the cash. Well, if you don't have private money, you're going to miss out on 87% of the pretty house deals if you don't have the cash, right? So that's my statistics. And like you just said, Bill, it really is an aha moment for a lot of real estate investors. You know, I have new real estate investors say to me all the time, Jay, I don't need any private money. I don't need any private money. I just want to do the pretty house business. Great. You can just do the pretty house business if you want to miss out on 87% of the deals, right? So cash is king. Cash allows you to buy when the seller requires all the cash, regardless of what the situation is. And in addition to that, private money has got nothing to do with your credit score.
No.
You can have a terrible credit score and get all the private money you want because private money is a collateral loan. Private money's got nothing to do with your verification of income. You can be stone cold broke and no job and get as much private money as anybody else, right? And I also hear students say to me, Jay, who's going to loan me private money? I've never done a deal in my life. Why are they going to trust me? Who's going to give me money on a deal? And
our students don't say that, Jay. No, our students don't say that.
Well, and the answer is very simple. And this is a writer downer. If you don't pay the private lender, the property does.
Yep.
If you don't pay the pay the private lender, the property does. And what I mean by that, we're not borrowing unsecured funds, right? We are giving the private lenders a security. We're giving them a mortgage or deed of trust that is backing that note by the real estate that we are borrowing. So if I lose my mind, if, I screw up, they get the property and they're going to make me even more money by having the property than the interest that I was going to pay them because I had bought it at such a big discounted price.
Now, Jay, I know there's somebody listening to us right now that thinks that you are absolutely out of your head that you would pay 8, 10, 12% interest. Why would you do that?
Yeah, well, I don't pay 12%.
I know, I don't either.
I do pay 10% now and then in second position. I don't mind paying 10% on $30,000 in a second position, second position junior lien. But why do I pay 8%? Well, here's a number of reasons. Number one, quite frankly, the access to the money is actually more important than the interest rate, to tell you the truth. Just having access to the money for quick closings. I close in 7 days.
Nice.
7 days. You can't close in 7 days with most hard money lenders.
Right.
In fact, with a lot of my private lenders, and they've got their money at Quest, I close in 3 days. So number one, I get more offers accepted, even when my competition offers more money for the property than I offered, because a quick, clean closing is so important to them. So why would I pay 8%? Number one, just access to the money, and I can close quickly, and I make the rules, and I don't have to make monthly payments unless I want to. My credit's got nothing to do with it. I mean, I'm willing to pay 8% to be in the driver's seat. Here's another big reason. As opposed to borrowing money from the banks or hard money lenders or mortgage brokers, there's a limit to the number of deals that I can do if I'm borrowing institutional money.
Yep.
If I'm using private money, I can do all the deals I want. There's no limit to the number of deals I can do. There's no limit to the number of private lenders that I can do business with. So private money takes the handcuffs off and lets me do as many deals as I want, make as much profit as I want, and be in control of my business to where I run it and it does not run me.
Nice. Plus, I also found that you're not really paying it, because when I negotiate, I know I have to pay that money, and I just make a better deal because I know if I can, because I am going to be striking the iron quick, and you can make better deals, right?
Sure. And I'm not even paying 8% on that deal unless I'm using the money for a whole year.
Right.
That percentage rate is the annual percentage rate.
Right.
Right.
Mhm.
So if I borrow $100,000 for easy figuring and it's an 8% APR and I only use it for 6 months and I cash out, I only paid 4% or $4,000 on that deal.
Exactly right. And most people don't realize that. All right. So here's the thing that is magical about you is you keep throwing these numbers and statistics around. So let's just label them as your formulas. So how did you come up with these formulas? And I know in my business, in fact, we've got 301 podcasts talking about my formulas, and just to be straight, I mean, I am a Ron LeGrand student. All my guys know that. I went to his seminars. He got me started 20 years ago. So that's where I learned, some of these formulas. But after a while, I just rely on my formulas more than my own thinking, because it is experience. So just tell us about how you if you can, came around to these formulas and why you use them, and the importance of it, and the automaticity of just sticking to the formula. If you could.
Well, I'm glad you brought up formula, because when it comes to making a decision as to how much you're going to offer on a house, how much you're going to borrow on that house, this is a right or downer. The math makes the decision, not your emotions.
Oh my goodness.
And boy, was I guilty of that when I started out. Boy, was I guilty of that. I was so excited, so, ready to get my first deals. And the formula said, don't offer more than X. And I'd say, oh, I can cut down on the repairs. It'll be worth a little bit more by the time I sell it. No. By the way, when it comes to repairs, it always costs more than you think it will.
No. And contractors will always give you the elevator ride.
Period. It always costs more than you think it will. That's why I have what's called in my formula the Murphy factor.
There you go.
The Murphy factor. So Pete and Bill, I'm sure you have taught, your formula for what's the maximum that you will offer when paying cash.
Yep.
Now, when you're buying on terms, i.e. subject to the existing note, seller financing, buying on a wrap, etc., that's a different formula. Okay. So the only formula that I'm reiterating here that Pete and Bill have already taught you, this formula is only for when you're paying all cash.
Ugly or pretty. Ugly or pretty.
Ugly or pretty.
Yep.
When you're paying all cash. And of course, we call that, and I learned it from Ron LeGrand, we call it the Mayo formula, which stands for maximum allowable offer. Maximum allowable offer. And Mayo does not stand for mayonnaise, right? It's maximum allowable offer, MAO. So that formula, as Pete and Bill know, that they can recite in their sleep, we're going to take the after repaired value. Now, where do I get the after repaired value? I get the after repaired value from my trusted realtor. I've been working with the same realtor for 14 years, Chris Latham. He does all my comps. I don't rely on any online services to tell me what the after repaired value should be. I let my realtor do that. I would rather my realtor do a CMA than me doing a CMA. I'd rather have a root canal. So he does that. And I've had a root canal, so I know what I'm talking about.
What's a CMA? We're on a rookie podcast. Just tell them.
That's right. So a CMA is a comparative market analysis.
Thank you.
Comparative market analysis. And so what my realtor will do is compare the subject property that I am interested in possibly making an offer on. He will compare that subject property to other sold properties, not properties that are listed in the multiple listing service for sale that haven't been sold yet, but to sold properties, and they would be comparable. Now, I'm wanting my realtor to give me an after repaired value, not an as is value, but an after repaired value. Well, how in the world is he going to do that? Well, Chris knows after all these years, if we renovate a house, we're going to make it absolutely beautiful. Granite countertops, LVP flooring, all new interior paint, all new interior lighting. It's going to look like a brand new home when we finish. So the sold comps that he's going to look for in the multiple listing service, he wants to get them as close to today's date as possible. Have they sold in the last 3 months? Have they sold in the last 6 months, etc.? So he's going to look for those comparable properties that are of comparable age and comparable condition of being absolutely beautiful. So he'll send me his opinion of what the after repaired value would be. In other words, what we would list it for, and what it should appraise for. Now, that's the after repaired value. So this is the Mayo formula. We take the after repaired value, and if the after repaired value is less than $300,000, we're going to multiply it times 70%. That accounts for your profits, some of your carrying costs, etc. So after repaired value times 70%, that gives you a figure, and then we subtract the estimated repairs. Estimated repairs. Well, how do you estimate repairs? That's another show with Bill and Pete. But you take your estimated repairs on the property, and then less the repairs. That's going to give you what we call the maximum allowable offer. Now, just to be sure, as I said, Murphy lives in every house. Who in the world's Murphy? If something's going to go wrong, it's going to go wrong. Sometimes Murphy's parents, sometimes Murphy's cousins, sometimes Murphy's children show up with problems that you did not anticipate. So less than 300,000, I just throw in an extra $10,000 below Mayo to actually be the most that I want to offer on that property. Now, if the after repaired value is over $300,000, then I'm going to multiply times 80%. Over $300,000 ARV times 80%. That'll give me a figure, less my repairs. That gives me Mayo. And then over 300,000, I'm going to subtract an additional, not 10,000, but I'm going to subtract an additional $20,000 because that's a higher priced home. And then that figure is going to give me my gauge as to really the most that I want to pay. And again, this formula that I'm using is only when we're paying all cash. And you know, Pete and Bill, that brings up another point to make, and that is when you're making your offer to the seller, you just don't make the offer. You got to justify your offer.
Yeah.
Justify the offer. Well, how do we justify the offer? Well, your seller could care less about your formula. They could care less about how you came up with it. I was like, I used to say, look, we just didn't pull this figure out of my ear. There's actually a way that we came up with it, and we would go through the formula that we use. They could care less. All they want to know is, am I really getting a fair deal? So how do you justify your offer? Here's how we justify our offer. This may be an aha moment for you. And when I say you, I don't mean Bill or Pete. I mean for you that is listening to this show. Here's how we do it. Now my realtor gives me comps, gives me comparable sold properties that were in repair, that were in disrepair, that were in the kind of shape of the house that I am now making an offer on. And guess what? When we show 1 or 2 or 3 of those properties that were in the condition of what we're looking to buy, now it makes sense to you, seller. They're able to see what other properties sold for in the kind of condition of what they are selling for.
That's awesome. That's very, very awesome. That's a great tip at the end there, because I don't do that. So I'm going to start doing that. That's awesome.
We're listening, Jay. We're listening.
All right, good. So now what about the formula of how much you're going to actually borrow once you get the Mayo formula?
Yeah. So I've got two formulas on that. Number one, we want to protect the private lender. We want to minimize their risk in case something goes wrong, something goes awry, they're still protected. So if there's a major rehab, okay, what's my definition of a major rehab? Well, I'm rehabbing a house right now at 400 Pearson Circle, and just the rehab's $160,000. That's the rehab. After I bought it for $230,000, right?
Dog.
See,
But the after repair value is 600,000. So the numbers work, right? but and that's out of the ordinary. That's out of the ordinary. I mean, I did just finish another rehab at 1010 Oak Drive. That rehab was 110,000. But those are out of the ordinary. Most of the time, my rehabs are going to be coming in between 30 and 50,000.
Yeah.
30 to 50,000.
Yeah.
So if I'm doing a major rehab based on those numbers, I'm typically not wanting to borrow more than 75% of the after repaired value. Yeah. 75% of the after repaired value. Notice I didn't say 70% of the purchase price.
Right.
If you borrow 75% of the purchase price, you're taking a check to closing, right? Mm-hmm. But when you borrow 75% of the after repaired value, well, how am I going to bring home a big check? Well, I'm buying it at a discounted price. Here's an example. Let's say the after repaired value on a house is $200,000. Well, the most I'm going to borrow in that example is $150,000. That's 75% of $200,000. But I will buy a house all day long. I'll buy houses all day long at 50% of the ARV. So a $200,000 after repaired value house, I'll buy all day long for $100,000 because it needs repairs and the seller can't sell it in the multiple listing service in the condition that it's in, right? Mm-hmm. Well, here's the cash, follow the money. If I buy it for $100,000, I'm not going to borrow more than $150,000 on a $200,000 after repaired value. How big's my check that I'm bringing home? $50,000. Yep. That's the difference between the amount I borrow and what I'm buying it for. But of course, I'm not going to keep all that $50,000. Most of it's going to be used for rehab, right? So 75% is my rule of thumb as the maximum of the after repaired value. Now, there's a caveat to that. Remember, we use cash to buy pretty houses when there's hardly no rehab involved at all. I don't mind borrowing 80% or 85% of a pretty house of the value. And here's why. Number one, I can get it cash flowing or sold right away. Right. My carrying costs are much, much lower. And number two, I'm not spending time on all that rehab stuff. So still giving my private lender a 15% equity cushion between what the home is worth and what I'm borrowing. So listen, if the house is worth $200,000 and I borrow 85% of that, then and I go lose my mind, well, they can sell it and they still made $30,000 because I gave them that equity cushion.
Exactly. All right, good. So we're going to wind down. We got about 10 more minutes, and I have a couple more questions. So this is all really good, Jay. I'm really glad you're here. This is great experience. But I gotta be. Normally Pete's doing this job, but I'm going to do it for him today.
Yeah, how you like being the rookie, Bill? How do you feel?
Yeah, the rookies, they're listening, and So first question is, you've taught a lot of people. So what have you found most rookies have barriers to getting started? Like, what are their barriers? And then the follow-up question is, let's just start with that.
I can tell you the absolute biggest barrier, hands down, no question about it, across the board. The number one barrier is the rookie not owning the real estate between their ears.
I say that all the time. I say the hardest real estate transaction they have is between their ears.
Absolutely. It's mindset. Yeah. So we got to get the mindset right first. That's first. Now, what do I mean by mindset? No chasing, no begging, no selling. You are serving. There's your mindset.
That's right.
You are a servant. How are you a servant? You're a servant by teaching people about private money and private lending to where they now can earn a lot of money safely and securely. And I don't know anywhere else where people can earn these kinds of rates of return safely and securely. The only complaint I've received from my private lenders over the years is, why didn't you tell me about this sooner? Right?
Not,
So it's mindset. I'm not pitching a deal. I'm not selling a deal. And again, it's the mindset. And you know, the worst time to attract and raise private money is when you need it for a deal.
yeah.
That's the worst time to be getting private money, attracting private money.
Too late.
I keep you up at night. So teach your program. So that's number one. Lack of confidence, fear. And look, here's the deal. If you are teaching somebody about private money, you can't lose. You can't fail. Now, if you're trying to raise money for a deal and you can't get it, now that's a problem. But if you're simply teaching people with this mindset about private lending and what it is and how they can get high rates of return safely and securely, you're just teaching them, right? And if they're not interested in the program, you didn't miss out. I mean, that's it. But I will tell you this, after explaining and teaching the private lending program for years and years and years, since 2009, I can only think of 2 people since 2009 that did not want to get involved. And both of them had the same reason. They were in the stock market. They didn't want to liquidate their stocks. The stock market was down at the time, and they did not want to lose money by selling their stocks in order to become a private lender. So I can tell you, and you all know it, Pete and Bill, you know it, anybody that's interested in listening and being taught the private lending program, they are going to be your private lender, because where else in the world are they going to get these returns? That's number one, mindset. Number 2 thing that holds them back is you don't know the program. How can you teach somebody what private money is and your private lending program is unless you know what your program is? Well, I got good news for you. I'm going to give away a brand new private money guide that I just wrote that's going to plug you in to the program that you can easily teach. And it's just so conversational to where the money will be chasing you. So mindset and lack of knowledge.
Exactly. So just because we're hooked up to the social media, Jamie's saying this is great information. She's very, very happy. So thank you for that. So, let's just, because we're kind of at the hour now, to break the myth, I think you've already done this, but to break the myth of it's difficult to get private money, I think you've covered that already. I think if you just, like you said, you educate people, that alone gets them excited. Now, I myself personally have run into what you're talking about a few times, not as many times as you would think, but they have their money in the stock market. The main thing between the stock market, because there's the 2 places to get the best return on your money, is stock market or real estate, right? My only solution to that is that the real estate is much more secure than the stock market.
Right. And I have another solution as well that I practice and also teach my students. So let's say you're talking with someone that's got stocks.
Yeah.
They like their stocks.
Yeah.
They don't want to sell their stocks. Well, guess what? There's this thing called portfolio loans. And here's the way it works. Anybody that's got stocks and they want to keep their stocks, they can go to their stockbroker and say, hey, I want to open up a portfolio account. It's got nothing to do with credit scores, nothing to do with verification of income. Most of the major brokerage houses have it. And so they open a portfolio account and now this is not margin. This is not opening up a margin account. This is a portfolio account. The way portfolio accounts work is if someone has stocks or mutual funds, they can open up an account. up to 50% of the face value of their stock brokerage account. So let's say they got $500,000 in the stock market. They can get a portfolio account of $250,000. Right now, the interest rate on borrowing portfolio loan accounts is a little bit less than 3%. So they can open up a portfolio account, and guess what? They can now be a private lender for you using their portfolio account. And guess what? The rate of return that they get by doing business with you using their portfolio account, and they still own their stocks, and their stocks are doing what their stocks are doing, the rate of the return that they get is called infinity. They cannot calculate the rate of return. And here's why. You come along as the borrower, the real estate investor, and let's say you pay them 8%. Now they're paying to their stock brokerage, say a little bit less than 3%, 2.75. So they get to pocket the spread between 8% and 2.75. But guess what? You can't calculate the rate of return. It's actually infinity. And here's why. They're not loaning you their money. They're loaning you the stock brokerage's money. And when they're loaning you the stock brokerage's money and they're paying you money on the stock brokerage's money, that's money that's like can't be calculated. Exactly. And it's the same thing as like a home equity line. They can go get a home equity line, do the same thing, loan you money from the home equity. They can pocket the spread. You pay them more than what they're paying on the home equity. And then there's whole life insurance policies. They can set up a line of credit against their whole life insurance policy, keep their whole life insurance policy intact, loan you money out. They pocket the spread. Again, it's called arbitrage, infinity rate of return for your private lender.
Jay goes out with a bang, huh, Pete? That's $1 million worth of advice right there.
That one I didn't hear.
And so let me see if I get this straight. So with the stocks, they're still making their money on their stocks, and they're making money on you. So they're making money twice now.
They're making money on money. They're like printing money out of air.
I mean, that's almost a dirty trick.
Let's do it. Exactly.
And very few people walking around even know about this thing called arbitrage and leveraging an asset.
Yeah, incredible. All right, Jay, so we're at our hour. What I would like you to do is, so you talked about this guide. I put a link in the description of this podcast, wherever you're watching it or listening to it, just because we didn't do our typical house work at the beginning of the show. Make sure that you subscribe to the show if this is your first time, so you can get our episodes every week. We are on YouTube and Facebook and Twitter every Thursday morning, 9:30 Eastern Standard Time, AM. So you can go to Facebook or YouTube or Twitter, and I have a screen up so you can ask questions and be part of the show if you so desire. But more importantly, in the description of this show on whatever platform you're on, there is a link to Jay's guide, which I checked out, and it is freaking amazing. So why don't you just spend a couple minutes just telling us about that guide, and then we'll end off.
Sure. So I just finished writing this private money guide. It's absolutely free. You can download it. And the title of the guide is 7 Reasons Why Private Money Will Skyrocket Your Real Estate Business and Build You Incredible Wealth. So this guide, whether you've never borrowed private money before or you're a seasoned real estate investor and you have borrowed private money, this will actually get you more private money. It'll get you on the fast track to private money. It will get you started on learning what the private money program is so you can start sharing it with your people that you have a relationship with. So if you have ever missed out on a deal for not having the money, or you just want to scale your business and get more funding for your deals while you make the rules instead of the banks making the rules, go to www.jayconner.com/money guide. Again, that's www.jayconner.com/money guide. Absolutely free. It will get you on the fast track to getting hundreds of thousands of dollars in private money for you to put to work right away on your real estate deals.
Perfect. And then just because I can't help myself, you could either go to that website that he just gave you, or you could put a support ticket in, because I know Pete and I are coming to one of your seminars in June in North Carolina. So if somebody wants to like jump right in and get more information, you're doing I think your next one, I might be wrong. Is there one sooner than June, or is that your next closest?
Yeah, June. The next one is June 8, 9, and 10, right here in Morehead City, Atlantic Beach, in our backyard. Yeah, at the live event, we got private lenders for the attendees to network with. I teach all 4 pillars of my business, and I dive super, super deep in this world of private money.
And I think at that
In fact,
event,
it's called the Private Money Academy Conference.
yeah, and I think also you also show at that event how you get leads, and it's more like you said, the 4 pillars. It's more than just private money. It's and there's bus rides and all kinds of stuff. So by the way, that's June of 2022, because these podcasts kind of hang around for quite a while. So that's 2022.
That's right. And again, I'm glad you brought that up, Bill, because when you download this money guide that I just told you about, you'll get information on how you can register for the upcoming live event, Private Money Academy Conference.
Perfect. And another compliment, Rudy, I think it's Rudy. He's saying thanks for sharing. Yeah. So great information. You guys rock. So Jay, I can't say enough for taking time out and spending time with us. Thank you so much for all of your help today. You gave us some very valuable information. I mean, I'm not trying to be a hotshot here. You know, I've done all these deals, and I still learn, and I still learn. I spent an hour with you today, and I got a couple good tips here, especially the stock market tip. Guys, take that as a lesson, because that's $1 million tool right there. I know 2 people right now that I can go to that have stocks. You know, they've probably got, one guy I think's got $1.4 million in stocks, and he's told me that he I'm going to go talk to him.
Yeah, I've got that answer. Stock. Okay, now I got an answer.
Yeah, exactly.
I just like to make money on money and money on money.
Yeah, exactly. Here's your printing press.
So look now, Bill and Pete, I want to hear how that goes.
Yes, absolutely. Absolutely. So, and like I said, we not that this matters to Jay, but for our listeners, Pete and I will be at that event in June. So if you want to come hang around and you're one of our rookies, then come on down and we'll have dinner or lunch together and hang around at Jay's event and have some fun. Okay. So Jay, again, any final words before we close off? I mean, I'm so appreciative. Thank you so much.
It's been great.
Bill and Pete. Yeah, thank you so much for inviting me to come on here and share my favorite topic. I had a blast. You all are fantastic hosts. Your podcast is just like taking off like gangbusters. And so I love it. And thank you so much for having me. God bless you.
All right. Thanks.
Thanks, Jay.
Over and out.